Right now, the stock market is sitting at record highs. Headlines keep repeating the same message: new all-time high again. For example, on December 11th, 2025, the S&P 500 closed at a new record level around 6,901. But here's what feels strange. If you stop looking at the screen and look at real life, it doesn't feel like a record. It feels tighter and more fragile. People feel stressed, and a lot of households are leaning harder on debt. In the U.S., total household debt rose to about $18.59 trillion in Q3 2025, and credit card balances reached about $1.23 trillion. So the question that should be impossible, but isn't, is this: how can the stock market be worth around $66 trillion while the economy people live in feels like it's cracking? If you feel like something doesn't add up, you're not crazy. Something really doesn't add up, and the reason is that the record market headline is built on a scoreboard that looks like wealth but doesn't behave like wealth. In this video, I'm going to explain the mechanism behind this illusion step by step in normal language without dumping all the facts at once. We'll walk through what the $66 trillion number actually measures, why it can rise even when everyday life feels harder, and what usually happens when confidence changes. This is educational content, not financial advice. The goal isn't to tell you what to do. The goal is to stop you from being hypnotized by headlines. Let's start with the number. The U.S. Office of Financial Research estimated that about $66 trillion in publicly traded U.S. corporate stock was outstanding as of September 30th, 2025, measured by the market cap of NYSE and NASDAQ stocks. That number is real, but it's easy to misunderstand. It's not a pile of cash sitting somewhere. It's market value. It's what you get when you take the last traded price of a share and multiply it by the total number of shares. That matters because the last traded price can change even if only a small amount of stock was traded, so the headline number can jump, and it can feel like wealth is being created, even when what's really happening is simply that buyers are willing to pay more. This is where people blame themselves. They see record highs and think everyone else must be doing great. Then they look at their own life and feel like they're falling behind. But the problem isn't you. The problem is the assumption that a record stock market equals a healthy economy for everyone. The market can rise while people feel squeezed, because asset prices and everyday costs can move in different directions, and because a lot of people don't have enough exposure to stocks for it to change their daily reality. At the same time, debt pressure can rise even during good markets. That's exactly what we see when household debt and credit card balances are hitting record levels. Now compare the market's paper value to the real economy. U.S. nominal GDP in Q2 2025 was about $30.486 trillion at a seasonally adjusted annual rate. Compared to roughly $66 trillion in market cap, it's easy to see why the market can feel disconnected. This doesn't automatically mean the market must crash tomorrow. It just means the market's paper value is very large relative to annual economic output. And multiple market cap to GDP tracking approaches have shown the ratio above 200% in late 2025, depending on timing and method. That's not a crystal ball. It's a warning sign that prices are stretched relative to the size of the economy. When people say the market is at a record, they usually mean an index like the S&P 500. But an index is weighted. The biggest companies have the biggest impact on the number. That means the index can rise because a small group of mega companies rises. In late 2025, reporting on Goldman Sachs research described how the Magnificent Seven drove roughly 43% of the S&P 500's gains into November. So the record can be narrow and top-heavy, not broad and evenly shared. Another support beam under the market is buybacks. Companies can buy their own shares, which reduces the share count and can support prices. In 2025, buybacks were huge. S&P Dow Jones Indices reported that S&P 500 buybacks hit a quarterly record of about $293.5 billion in Q1 2025. Later figures show Q2 2025 buybacks around $234.6 billion and a trailing 12-month total through June 2025 around $997.8 billion. Buybacks aren't automatically bad, but they do change what record highs can mean, because a lot of stock demand is coming from the companies themselves. Now zoom out to the background environment. In fiscal year 2025, total U.S. government spending was about $7.01 trillion, and total revenue was about $5.23 trillion, leaving a deficit around $1.78 trillion. This doesn't mean the government directly buys stocks. It means the financial system is constantly absorbing massive financing flows, which shapes liquidity, bond markets, credit conditions, and investor behavior. When the system is being financed at that scale, asset prices can stay elevated even while daily life feels pressured. Here's why record highs can feel empty. Markets and companies report results in dollars. If the dollar loses purchasing power over time, prices can rise across the board. Companies can show higher revenues in nominal terms, stock prices can rise, and people can still feel poorer because everyday costs rise too. So a portfolio can look bigger on a screen while real buying power doesn't improve much. That's why the headline record market doesn't automatically mean record prosperity. This illusion is not evenly felt. People who own more assets benefit more when asset prices rise. People whose lives are mostly wages and cash feel rising costs more. Even stock ownership itself depends on how you measure it. Gallup reported that 62% of Americans in 2025 said they own stock, including through retirement accounts. A Philadelphia Fed survey-based report found that in January 2025, 42.8% of adults in their sample reported personally owning stocks. Different measures, same message. A large share of people don't have meaningful exposure to record market gains, even while they still face higher costs and debt pressure. Now look at what disciplined capital does when things are expensive. Buffett doesn't need to shout. You can look at Berkshire's actions. Berkshire Hathaway's Q3 2025 filing showed very large liquidity, including about $72.156 billion in cash and about $305.367 billion in short-term U.S. Treasury bills as of September 30, 2025, roughly $381.7 billion combined. In simple terms, that signals patience. It suggests that when prices look stretched and good deals look rare, waiting can be a strategy. Nobody can time the moment confidence flips. But record does not equal safe. Reuters noted that at the December 2025 record close, the S&P 500 was trading around 22 times expected earnings, above its 10-year average of 19. That doesn't predict a crash. It simply shows valuation is elevated versus recent norms, which reduces the margin for error. When confidence breaks, liquidity can vanish, and prices can drop faster than people expect, because the $66 trillion is a price tag, not a vault of cash. So here's the 66 trillion lie. The lie isn't that the number exists. The lie is what people assume it means. 66 trillion is a market cap price tag, not a pile of cash. A record index level can be driven by a small group of giants, supported by buybacks and shaped by a financial environment influenced by massive government financing flows. Meanwhile, households can still be under pressure with record debt and rising living costs. The takeaway isn't panic. The takeaway is clarity. Stop letting record highs make you confuse a higher number on a screen with a stronger, safer real economy.